My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. Just trying to save you a little money over here. My job, entertain, explain. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. Some like it cold. All right, that's a little twist on a famous movie, Some Like It Hot. But it's also a formula for investing that's going way out of style. I think it could return soon, maybe sooner than you might expect. See, the averages got hit today. Dow dipping 180 points, S&P sliding 0.41%, NASDAQ losing 0.89%. But we know that certain parts of this market are as hot as a just-fired pistol. Tonight, though, I want to praise the other parts of the market, the parts that have been marked down already, which makes them less vulnerable to surprises. And I'm talking about healthcare, a group that used to represent safety, always has some growth, but is now considered poison. These are now, unbelievably, healthcare is a value stock right now, and I like value, especially when it's attached to a growth industry like healthcare. We need growth because it seems like, well, it's slowing in some very unlikely places, at least historically. See, it's causing me to rethink some kinds of growth and gravitate towards others. Why? All right, let me explain. Especially if you watch the show, you know what I'm talking about. Last night, we had Bill McDermott, CEO of ServiceNow, on the show. Reported a perfectly good quarter, one that passed the august rule of 50. Revenue growth rate plus profit margin equals more than 50. Very good sign for a cloud software play. There were huge signups. Many clients embraced their AI controller model, letting them automate their workflows and more. But here's the problem. In an era where artificial intelligence can mimic very good software businesses, it's hard for ServiceNow stock to get a decent valuation. Too many on Wall Street are terrified that this kind of company has no future. Hence today's staggering 17% decline for this stock. ServiceNow, this stock, is now down a ghastly 44% for the year. 44%. Plus, even though ServiceNow stock has already been pummeled, that doesn't even necessarily mean it's gotten cheap. As Ben Reiches at Melius tells us, lots of their employees get stock as compensation. If you were to treat that as real cash compensation, as you and I might, then even after today's dramatic fall, 103 to 84 and change, stock sells at 37 times earnings, much more expensive than most of the S&P. Now, I've gone over everything that McDermott told us about half dozen times. Here's my conclusion. ServiceNow is doing exactly what it's done for years, but it's no longer going to be given that same price-to-earnings multiple because artificial intelligence is cheaper, and even if it doesn't wipe them out, it can put pressure on pricing. And you don't get a premium multiple if your company's pricing is under pressure. The market's changed. The buyers turned into sellers. Doesn't mean ServiceNow isn't a great company. It is. But institutional money managers who determine the prices that you see won't pay up as much for that kind of greatness when it's an enterprise software vulnerable to the great disruptors we talk about all the time. The stunning decline in the stock rocked the software index, taking almost every one of these down, as holders believe that their software stock could be the next victim of Anthropic or OpenAI. Probably an exaggeration. Some groups like cybersecurity have a lot less AI displacement risk. Private equity groups got crushed too, as they own the debt of many cloud software companies that have gone private in the past. That debt's now under suspicion for the same reason ServiceNow got rocked. It could be unfair, but no one's going to let you get your money back from these things. These aren't vacuum cleaners, people. There's no warranty. And certainly no returns. How about this for a stock? Caveat emptor. At the same time, we got hit by big layoffs at Meta today. That came midday, but I think Mark Zuckerberg is being efficient. When the market heard Meta's firing 10% of its workforce, it read that is meaning that the business must be faltering. That's completely untrue. That's his style. But the pin action hurt a lot of stocks. They didn't all recover. He's efficient. He's efficient. I just like that. All right. Microsoft also offered buyouts. All right, that stock got hit, too. We can't presume anything anymore, but we do know that software stocks got walloped, not just by ServiceNow, but by Microsoft's moves. We're not used to seeing the sector get hurt like this. This sector's been charmed since 1985. And if these stocks didn't have any fluff in them, then it wouldn't be so hard. Now, some of this market's just plain negative. I mean, look, Tesla reported, all right? I liked everything they said. And I'm not, it's not like I hang out with Elon Musk, but I will tell you that what he's going to do with robots is revolutionary. You want to sell that stock, you're selling robots. You're selling full self-driving cars. You're selling the future. But go ahead, sell the future. I'm not a seller of the future. I'm a buyer of the future. Now, apparently, that's no longer good enough. Maybe you have to have, like, the super future. Let's hope that Intel, with magnificent surprise, top and bottom line, tonight, can turn things around. What an amazing quarter from Lip Bhutan. It's been there for 1 year and 1 month. It's almost a miracle. It is a miracle. It's a miracle. It's a miracle. I'm looking at my staff as hell, and it's a miracle. They're talking about a miracle, too, over there. All right. Now, it can't cover the stench of enterprise software, though. I don't think anything can cover the stench of enterprise software. Even like the absolute best kind of cologne or perfume or like Chanel. I think Chanel's still good, right? I mean, what else people use these days? All right, anyway. So how did Chance, my wife likes Chance. So how do you protect your portfolio from these kinds of brutal declines? I got an idea. Why not own some stocks that have already been pulverized, already been gaffed, already been filleted, even as they represent very good companies? Why not own some healthcare? Let me give you some examples. Let's start with a solid company with a stock that sells at 11 times earnings, CVS. I'm all buying it for the Charitable Trust, but we held off because we have too many positions. CVS owns Aetna, which I think is a pretty good, it's not maybe as good as United Health, but pretty darn good company. Reported a tremendous quarter earlier this week, but United Health is certainly in the ballpark. I think Aetna is good. CVS owns 8,932 drugstores. Not that long ago, there were 3 big drugstore chains: Rite Aid, Walgreens, and CVS. Rite Aid, bye. Walgreens got taken private. It's now pulling back from a huge number of stores. They may not even be a factor at this pace a few years from now because they're private, though we don't really know what it is. But I know something. CVS CEO David Joyner gave you a terrific quarter last time. I think it's only going to get better as the competition disappears. I prefer CVS to ServiceNow. Okay, I'm out there. Next, I'm a huge believer in Cardinal Health, with a stock that's just been annihilated here without any reason. I think a vicious rotation out of healthcare. Cardinal is down from 233 to 204. It's beaten the quarterly estimates repeatedly. Shifts its model from being a pure middleman to being a drug wholesaler to being a manager of services to its clients offer. Given the complexity of large independent medical organizations, Cardinal's filling a gap in management for some specialty chains that really don't know how to run their own business. I think there's maybe many more to come. High growth that now trades at less than 20 times earnings. To me, Cardinal's a steal, although we've been buying for the Charitable Trust, and admittedly, I started early. Some would say wrong. Okay. Or how about a stock they talked about earlier in the week that's doing nothing? J&J, Johnson & Johnson, AAA balance sheet, one of only 2, the other being Microsoft. J&J is the best pipeline of potential blockbusters of any pharmaceutical company, yet it sells at a little less than 20 times earnings. These are discounts. Okay, finally, we're going to get to the one that you're going to buy tomorrow, right? United Health Group. Here's a company that just reported its first solid beat and raise quarter in a very long time. Returning CEO Steve Hemsley, who turned UNH into a juggernaut before he retired in 2017, is back. And he's doing the same thing he did for years the last time he was CEO. Produced the best earnings and biggest upside surprises, and they're real. They're not chimerical. They're not made up. They're none of that jack stuff. Yet, after all of that, after putting up the best managed care earnings I've seen in ages, stock still sells for just 19 times earnings. Boy, this group is hated. The man is just getting started. The stock deserves to be much higher. Okay, here's a little clue. UNH, we'll do a little cinema verite here. I like the cinema verite. UNH is at $354. This stock was at $600 last April of 2025. You know why I like these stocks so much? Because if they come down further, you can just keep buying them hand over fist. Because you know what? When they go down, they actually get cheaper. You cannot say the same thing about the vast majority of the tech stocks, particularly software. Bottom line, I think these quality healthcare names help to balance out your portfolio right now. Given you something that they can't be savaged by AI displacement that I can tell, good balance, something tells me you're going to need it. And the stench of software, I have to ask my executive producer, you got anything? Like a perfume? No perfume. Nope. All right. I tried to help the group. Don't have it. No perfume. All right. Let's go to Nick in Connecticut. Nick.
Hey, Jim, it's Nick from Connecticut. How you doing?
I am doing well. How about you, Nick?
Beautiful spring day here in Connecticut. Hey, listen, I'm a longtime listener and club member, and just want to pick your brain about Home Depot. I bought it a few months ago.
Yeah, okay, so we understand. Home Depot is, when I did the Home Depot work for the trust, Home Depot is a it's a template, okay? It's an example. It's an analog. Home Depot is what you buy when you get rate cuts. It is time-honored. I have studied it since 2007. Actually, I studied it since it came to Elmont, Long Island in 1987. Go check me on that. This is the stock you own when you get rate cuts. You don't buy Intel when you get rate cuts, although you should buy Intel. I can't believe I've been saying good things about Intel. I never told people to just buy Intel. All right, look, you got some balance in your portfolio for days like today. You don't want to get burned endlessly by software, enterprise, or SaaS. All right, we got an action-packed lineup. I just wanted to always say that action-packed because all the other anchors say that. Action-packed, action-packed. It's a very full show. What does that mean? This powerhouse chemical producer, Dow, is going to be on. Critical role in supply chains around the world. I'm learning more about the road ahead for the company's outgoing CEO. The shares of Thermo Fisher tanked today after reporting top and bottom line beat. What the heck's going on? I'm going to go straight to the company's top risk. And PG&E is trying to power up its growth outlook. I'm going to get an update right from the bankable CEO. Chock full show. I mean, like huge. I mean, I can't believe it. Dynamic, gigantic show. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.